So there's a number of common items that must be adjusted when you're trying to move from taxable income to what is true practice profitability. Owner payments are one of the biggest items. It's a rare practice where the amount that is shown as owner compensation in the tax return really equals a fair market value for that compensation. And we'll talk about each of these items in a little bit more detail as we go, but I want to just give you the list of them first. The perks that we talked about earlier, the personal accounting policies, so those are the trips to Tahiti, the liquor store bills, etc. That's a common adjustment for most practices. There are sometimes services provided to the practice by family members, and those are not recorded in the financial statements at fair market value rates. Facility and equipment rental often needs to be adjusted. Interest on debt, non-cash expenses such as depreciation and amortization, and non-recurring income and expense items. Slide 25. The first one of these adjustments that we'll talk about is owner payments. Owners generally receive cash from a practice for multiple items. They may receive cash as compensation for their medical and surgical services. They may receive it as compensation for management services. Indirectly, they get cash when these perks, when these personal expenses are paid by the practice. They may receive rent payments from the practice for either the real estate that is also owned by the practice owner or equipment that is owned by the practice owner and leased to the practice. They may get cash as a repayment of loans that were made to the practice a number of years ago, and then ultimately they take cash out of the business as a part of the profits. These items, however, are generally not recorded correctly in the tax return or the financial statements for the calculation of true practice profitability. They may be recorded correctly for the preparation of a tax return, but not for the calculation of profitability. Compensation is not always paid via payroll, and profits are not always paid as dividends. So if you have a sole proprietorship, an owner does not get compensation through the payroll system. They simply take out draws every month or every quarter, and draws don't show up in the profit and loss statement or on the tax return. So because of the way that the tax law requires these different things to be treated, or some of the choices that the owner makes, the practice can either be more or less profitable than it really is, or appear more or less profitable than it really is. So let me give you an example on owner compensation. Let's say that you have a veterinarian in a practice, an owner who is producing $600,000 a year. And on the tax return, he or she shows $50,000 in salary. The fair market value compensation for this owner would be closer to $120,000. If you took their $600,000 in production times 20%, which is an average production percentage, then they would expect to be paid, if they were working out in the free market, $120,000 for their medical and surgical activities. In this tax return, because there's only $50,000 in salary showing up, the practice profits are actually overstated by about $70,000, and that's the difference between the $120,000 that they should be paid on a fair market value basis and what was recorded in the tax return. If you assume that this practice has a multiple of 4, and I'll come back to the multiple concept in a minute, then practice value, if you just use the tax return to calculate the practice value, this value would be overstated by $280,000. The multiple is sometimes kind of a tricky concept, but let me just try to explain it simply for the purposes of this webinar. In most valuation techniques, the person appraising the practice goes through and calculates what's the true cash flow of the practice. Starts with the true profits of the practice, adjusts it to cash flow, and then that cash flow is used to determine what the true value is. And that's usually done by multiplying that cash flow by some number. And the multiple, what that number is it 4, is it 6, is it 5, is it 2, is it 7, is it whatever, is determined by analyzing the risk factors in the practice. And those are the factors that help you understand whether this practice is expected to be as profitable in the future as it is now. For the purposes of this webinar, don't worry about how you get to the multiple, but just understand that even relatively small differences between an item that appears on the tax return and what that number should really be can have very large effects on practice value because of the multiplying effect. This is slide 28. I want to talk now about practice perks, or those personal accounting policies. The perks are the items that are not necessary to the operation of the practice but are expensed by the practice owner and their accountant, generally to gain a tax advantage. And like I said earlier, those are things like excess meals and entertainment, personal automobile costs, swimming pool payments, personal furniture, trips to Tahiti. You could go on and on and on. When you include these perks as expenses in the tax return, it makes the practice appear less profitable than it really is. Most good quality appraisers will go ahead and pull these perks out, assuming that there's enough documentation to make the appraiser comfortable that they really are not necessary practice expenses. And then that way you get a better idea of the true practice profitability. This is slide 29. Let me give you an example of the impact of practice perks. Let's say in this practice that the owner's personal internet service is included in the tax return as telephone expense, and that has a dollar value of $360. There's vacation costs that are included in the travel expense account of about $5,000. There's personal automobile expense that's included in the practice vehicle expense, and that's about $10,000. There's personal dry cleaning expense that's included in the business laundry expense account of about $500. There's personal liquor store bills that are included in staff meetings and events expense, and that's about $3,000. There are also weekly family dinners that are paid for by the practice, and that's included in meals and entertainment expense, and that's about $5,200. If you add up all of those personal expenses that are included in the tax return, it comes to about $24,060. So that means that practice profits, if you're just looking at the tax return, are understated by about $24,000 because we deducted things that are not really necessary to the operation of the practice. Again, if we use a multiple of 4, that means the practice value would be understated by $96,000. So it's a very significant impact once you include the multiplying effect. Another common adjustment to get from taxable income to what the true practice profits are is necessary if you have family members that provide services to the practice. One of the most common things you see is a family member that provides bookkeeping or management services to the practice at no charge. And historically, the classic example has been a male veterinarian who owns a practice and his wife who did the bookkeeping or the practice management. And oftentimes the wife was not paid for that work or was paid at a less than fair market value rate. If you think, though, about the true economic value of that work provided, it doesn't make sense that there's no cost assigned to it. If the practice had to hire somebody to do that work who was not a spouse, they would have to pay for it. So that an estimate of the fair market value of those services has to be included in this calculation of practice profitability. You can also see family members that are overpaid. I've seen practices where children get salaries and retirement plan contributions, but they haven't shown up in the practice in the last 5 years. So these payments that are made or not made to family members can make the practice appear either more or less profitable than it really is. This is slide 31. Here's an example of how the services provided by family members can impact profitability and practice value. Let's say that the owner's children receive $10,000 a year in compensation, but they never show up at the practice. On the tax return, the practice profits are understated by about $10,000. Again, if we come back to this concept of a multiplier to get to practice value, the practice value would be understated by $40,000. This is slide 32. Another example is an owner's wife who does the bookkeeping or the management at no charge. And let's say that she works 20 hours a week and a fair market value rate for her services would be $40 an hour. She's working 52 weeks a year. That would come down to $41,600 is what a fair market value for her services would be. Because she's not being paid for that, the practice profits are overstated by $41,000 and the practice value would be overstated by $166,400. Now we're on slide 33. Another area that commonly needs to be adjusted when you're trying to translate taxable income to practice profits is facility and equipment rental. Oftentimes, the most common thing that you see is rent expense that's paid by the practice to the owner of the real estate, who generally also owns the practice. That rent expense that's included in the tax return may or may not be at a fair market value rate. Oftentimes, the rent expense was established 10 years ago when the owner started the practice and had first bought the real estate, but rent rates have changed since then. They could either have gone up or down, and so the rent expense doesn't really reflect the current market. You'll occasionally see this same issue with equipment lease expense, though that's not nearly as common as it is with real estate. But because these items are not included in the tax return at a fair market value, the practice can either look more or less profitable than it is. I'm on slide 34 now. Let me give you an example of this real estate issue. Let's say that the practice owner, so the person who owns the veterinary hospital, also owns the real estate, and the practice pays the owner $3,000 a month in rent. This rent was set back in 2003. It's a total of $36,000 a year. But the practice facility, when it was valued a year ago, had a value of $1 million. And there's a little rule of thumb out there that's often used that says the rent, the annual rent, is about 10 to 12% of the fair market value of the facility. So in this case, we would say that the estimated fair market value of the rent is about $100,000, and yet the owner is only being paid $36,000. So the practice profits are overstated by $64,000. And again, if we assume a multiple of 4, the practice value, if it was prepared just using the tax return without these adjustments, would be overstated by about $256,000. I'm on slide 35 now. Interest on debt also has to be adjusted. You do need to look at the types of interest incurred. If the practice regularly pays interest on their credit cards or late fees on their credit cards, and that's going to continue into the future, then I would not pull that out in the calculation. But most interest paid by a practice is not an essential operating expense. So it's interest paid on the debt used to acquire the practice or the debt used to buy a piece of equipment, and that's considered a finance expense and not an operating expense. So interest expense, while it's okay to deduct it on the tax return, should not be included in the practice profitability calculation, and that makes the practice appear less profitable than it really is. Slide 36. Here's an example of the impact of interest expense. Let's say the practice has a loan that they use to buy equipment, and there's $7,000 in interest expense per year. Because that interest is included in the calculation of taxable income, if you just assume that taxable income equaled profits, the practice profits would be understated by $7,000. Again, assuming this a multiple of 4, the practice value would be understated by $28,000. Slide 37. I want to talk briefly about depreciation. This is a non-cash expense that you see on every tax return. Depreciation is the IRS's way of expensing equipment purchase costs in the various periods the equipment will be used. Depreciation, or the way you calculate depreciation, is determined by the IRS, and it generally has nothing to do with financial reality. It's just some number they came up to provide a tax benefit, but it doesn't necessarily equal how you use that equipment up. And what you're really trying to do here is take a piece of equipment that you've purchased, let's say an ultrasound machine, and you paid $35,000 for it, and you think you're going to use it for 5 years. So if you take $35,000 divided by 5 years, that would be roughly $7,000 expense per year. And that's as you, quote unquote, use up the equipment. However, the IRS may let you depreciate the entire $35,000 in the first year, or spread it out in a different way over 3 to 5 to 7 years. And that means that the taxable income number on your tax return does not really represent how much of that equipment you're using up each year. And again, that can either make your practice profitability look too high or too low. This is slide 38. Let me give you an example of depreciation. Let's say that your current year depreciation on your tax return is $12,000. And in your practice, the average amount spent on new equipment each year is $30,000. What you're really trying to include in the calculation of practice profitability is the average amount you spend per year on new equipment. Not necessarily on big ticket items like the purchase of digital x-ray, but just to keep the same level and same quality of equipment that the practice normally has. So in this example, there's about an $18,000 difference between current year depreciation and the average amount the practice spends each year on new equipment. That means that the profits, if you just looked at the tax return, would be overstated by $18,000, and the practice value would be overstated by $72,000. This is slide 39. What I've just been talking about here over the last few minutes is the common adjustments that you see in order to take taxable income or net income on the practice's income statement and translate it into true practice profitability. And what this slide shows you is the effect of these common differences. What I've shown here in the first column is the practice taxable income, the number that shows up on the tax return. And then I've shown in the second column the same practice, but after we've made the adjustments that we've been talking about over the last few minutes. So you'll see here that revenue in this practice is $1 million, and we didn't make any adjustments to revenue. We didn't have any adjustments to the cost of professional services. But when we came down to owner compensation, we did need to make an adjustment. And if you'll remember, in the tax return, only $50,000 of owner compensation was included. However, this owner produces $600,000 in production, and a fair market value salary for this owner would be closer to $120,000. So we've changed the $50,000 to $120,000. In the support staff line item in the tax return, $220,000 was included as support staff compensation, but we had the kids that work in this practice, or the kids that get paid from this practice but don't actually do any work, that we needed to make an adjustment for, and we also had a spouse who provided free bookkeeping services, and we needed to make an estimate of the fair market value of the spouse's salary. So the new and correct support staff compensation is $251,000. We changed the rent to a fair market value of $100,000. Only $36,000 was included in the tax return. The perks that this practice had, and remember they were roughly $24,000, and for purposes of this slide I've just lumped them all in repairs and maintenance. So the tax return showed $30,000 worth of repairs and maintenance expense, but $24,000 of that were perks. So the true repairs and maintenance expense was $5,940. Depreciation had to be changed. The tax return only showed $12,000, but on average this practice spends $30,000 a year on new equipment. And then in other expenses, we also had to adjust for the interest expense. And so the other expenses on the tax return were $75,000, but we don't count the interest expense as an operating expense, so that's adjusted to $68,000. The biggest point of this slide is the difference in the bottom line. If you just looked at the taxable income, it would appear to be $186,000 for this practice, or a profit margin of 18.6%. That's a very, very good profit margin. However, that's not a true profit margin. Those are not true practice profits. Once you've made all of these adjustments to show what the true fair market value of all of the expenses are, this practice only has profits of $33,460, or a profit margin of 3.3%, and that's not a very good profit margin. So it's very, very important that you go through this calculation in order to determine what true practice profitability is.